Welcome to the PlanVision podcast, where we share simple, straightforward investment and planning ideas for normal people. The description in this podcast is for informational purposes only. Do not construe this as personal tax, financial, or legal advice for your situation.
Hey there, this is Mark Sorrell with the PlanVision podcast, and I'm delighted today to have Nick Macrina with me from Vanguard, and we're going to talk about target date funds. Now, I love target date funds. I have all my money in the 2045 target date fund, and I know that this is the maligned investments by the advisors and the bogleheads and all those types of folks, but I think they are absolutely fantastic investments. So Nick is going to share with us a little more information about the target date funds. Hi, Nick. How are you?
I'm well, Mark. Thanks for having us. It's always a privilege, really, and a pleasure talking with advisors like yourself, but also hopefully this reaching a lot of our clients. So thanks for having us on.
Great. So can you describe quickly, before we go into the discussion of that, what your role is with Vanguard?
Yeah, absolutely. You know, I feel very privileged to have this role, and really I think of it as a cheerleader, if you will, for Vanguard's views and insights in the marketplace, right? I mean, Vanguard is such a large investment shop. You know, now at the end of October, we have over $7.7 trillion in assets under management. Now, that's, of course, inclusive of target date assets. It's also inclusive of a lot of index and ETF assets, which a lot of clients know us for. But it's also over $1 trillion of active assets as well. So a lot of insights in the marketplace and an economics team that's housed here at Vanguard that we're really tasked with listening to and then kind of turning around to our investors and our clients like yourself and end clients and sharing that so they can make better investment decisions and build better portfolios. Okay,
great. Well, let's move right into my first question was, at this point, what percentage of assets within the Vanguard total asset base you referred to are in target date funds?
Yeah, it's one of our largest franchises. It's just as of the end of October has now grown to over $1.2 trillion of Vanguard assets. So a pretty significant portion. Keep in mind that's about 7.7 trillion. So it's about 15% of our AUM. I think even more impressively is that that's actually over 50% of the target date assets in mutual funds in the entire industry. So
I see.
It's a testament really to how much investors, particularly retirees, are trusting Vanguard with assets.
And would you know the distinction maybe of how the TDF lays out in your asset base as far as the quantity that's in retirement plans or defined contribution plans as opposed to just retail investors? My assumption is that a lot of those assets are through employer-based plans.
Yeah, and your assumption would be right. But surprisingly, 20% are held outside of retirement plans, which is always a number that when I first saw, I remember being quite taken by, just because I figured all the assets were either in plans or qualified accounts, like a rollover account. But that's even though it's a small number of the 1.2 trillion, the 20%, it's almost equally as in terms of investors voting in favor of Vanguard, because that's such a discretionary decision versus a lot of times in plans it being a default investment choice. So it's a mix, but predominantly, to your point, your assumption is correct. It's mostly in employer plans.
Yeah, when I used to have my business where I worked with small employer-based retirement plans, we would use the Vanguard, the Vanguard Target Date Fund as the default choice. And I thought that was awesome. But it is nice to hear that there's plenty of simpletons like myself that love using the Vanguard Target Date Fund.
And myself.
Oh, awesome. Well, two of us.
Yeah, absolutely.
So the stock bond weighting which makes up the target date fund. The target date fund is a fund that has an asset allocation model that changes over time. How is that glide path determined? Who are the wizards that come up with that?
Yeah, the wizards is a great word, because it is a sophisticated process. Despite the fact, if you were to chart it, it might look pretty simple. But it's really built, like many things at Vanguard, off of pretty simple premises, right? The two things that we really believe when we build this glide path is, one, is that the equity risk premium will continue to exist. And that's fancy language for when you're a younger investor, you want to own stocks because generally they return more than bonds. Now, over shorter-term time periods, there might be more volatility, but over the life cycle of an investor, you want to have exposure to stocks. And that component, that duration or that time component is what we defer this trade-off between human and financial capital, right? And when we're young, we have a lot of human capital. And as we get older and we get closer to retiring, we have more financial capital, hopefully less maybe working years available. And we're going to wind down that allocation to stocks because, again, it's the riskier component. It's the growth component of the portfolio. Because the goal's changing, right, Mark? I mean, when you're young, you want to raise as much assets in that nest egg. The day you retire, it's not about growing that as much as it is, let's make these assets now work for us, replace our income so we can live a life that we really wanted to in retirement. And that winding down is what's called the shape of the glide path.
So the actual allocation percentages change over time, and maybe they begin to change more with bigger changes, 45, 48, somewhere around there. And I think you and I had talked about this before, that the actual percentages, though, I guess the appropriateness of those percentages, Vanguard uses a fair amount of research that you pull internally. Is that true? Can you comment about what that research is and where do you get it?
This is a really cool part of these target date series, and I would say there's foremost. I would say the shape of the glide path is very modular, or not modular, but very, I would say, quantitative, right? In terms of the youngest investor, what we call phase one, will have 90% of their assets allocated in equities, right? Fairly aggressive, and they will have that until roughly age 40, when it will begin to wind down in a somewhat linear shape, not perfectly, to, and what we call now through retirement. Now, the analytical portion of this is that the shape in which from 40 until when we stop reducing, or we have the minimum amount of equities in the portfolio, which would be 30%. So going 90 to 30 is all driven on an array of quantitative inputs, right? That's going to be things like, population characteristics on one side. So think about savings rates, spending in retirement, and then also asset class projections, right? What are our stock and bond projections? That's really kind of the numbers part of it. But the really cool part of this behavioral part, is when investors start drawing down from these accounts, is typically what we find using our internal data about 7 years after full retirement age, 66. So we don't stop at 66 in terms of de-risking. You'll still have some equities because you're not touching that money. It should still continue to grow. And that's different from some of our competitors in the marketplace.
Yeah. So which leads me to my next question. That is, so I was for example, an investor was in the 2020 target date fund. It's now 2021. That 2020 fund will stay as a 2020 fund for how long? And then what ultimately happens to that fund?
Right. So if you're in a 2020 fund and you're hitting the full retirement age at about 7 years after, once it becomes the 30% in equities and 70% bonds, it will roll into what we call the income fund, which is just really the final destination for the portfolio and where it will be static between the allocation won't really change.
All right. So eventually the year drops off and it just becomes an income producing fund. Let's
Right.
talk for a moment about how the asset allocation model is maintained. And we could just pick a fund, the 2040 fund. So it has a target mix, and it's going to strive to stay in that mix. How often is the fund rebalanced or brought back to its mix based upon market performance?
Yeah, so we have a unique approach to rebalancing at Vanguard that's systemic to really all of our multi-asset funds or other than target date funds. And it's really with a goal of doing it as infrequently as possible, right? Because by having an allocation to stocks and bonds, the market should take care of some of that in itself, and that's diversification. Now, as we all know, sometimes it doesn't work perfectly, and there is a need to rebalance. And that's why what we have is what we call dynamic rebalance. So if, let's say, the allocation is meant to be 60-40, we will let that band go about 2-3% away, which will trigger what we would call a review. And that's more or less saying, hey, portfolio managers, the allocation is a little off a base. Would this be a good time to rebalance? And the reason why we do a review instead of a hard, let's rebalance now is because we can rebalance with just cash flows as well. And two, it might not be a great time to rebalance, right? We think of what happened in March of 2020 when a lot of the asset allocation models got out of whack. It was very expensive to trade both stocks and bonds, so it made sense to wait. If it does get to 5%, we will hard rebalance because at that point, the risk return characteristics are changing, but it's a way that we can be prudent in charging expenses because it's an expensive endeavor to rebalance $1 trillion worth of assets.
I see. Okay. Question that I have, which I think of myself as well, as I work with clients, they'll ask me, Mark, what is the right amount of international to have in a fund? And of course, that is just a debate that commentators, observers, investors can have, the right amount. And I'm not, from my perspective, I'll tell my clients, it's really up to you. Nobody really knows what's going to happen in the future. Now, at a personal level, I like the idea that I have what seems to me to be a fair amount overseas. I think it's 30-35% in my TDF. Would it be safe to say, and correct me on maybe another way to characterize this, but a target date fund is a replication of the global stock and bond markets? Is that, if I were to use kind of a glib comment like that to an investor, would that be a good way to describe one of these investments?
Yeah, if you came to Vanguard and you bought a target date fund, you would get is one that is fairly representative of the global market cap, right? So the stock allocation will be 60% in the U.S., 40% in international markets. Technically, if you're to look at global market cap, there's a little bit more in international. But 40% is a healthy weight and substantially more than most of our clients have in that marketplace. And even with our bonds, we know it's going to be 70-30, 70% in the US, 30% internationally. The market cap there is probably a little bit more like 50-50, but this is also substantially more international exposure than you would see most clients have. And that's in a lot of target date funds. So yes, we're trying to replicate the global market cap. We have about 90% coverage with our target date funds. And that goes back to the first principle of what's the most important thing when constructing a retirement tool to accumulate assets. And that's exposure to risk assets, right? It's not this asset should outperform that assets. It's just steady exposure to global market cap. And that's why we've made a decision to own that type of exposure.
Yep. How many holdings might the target date funds actually have?
Yeah, that's another that's one of my favorite questions because it's really this branding and this label that the target date series uses, which is outwardly straightforward, but inwardly sophisticated. And that's because they're tickers, right? Or they're simple. You look at the income fund or the 2050 fund. And it's really, we talk about them as stocks and bonds, but there are 25 sub-asset classes that underlie these stock and bond holdings, which are inclusive of 45 countries and almost 30,000 securities. So when we're talking about exposure to 90% of global market cap and diversification and that risk premium, which is so important to accumulating wealth, we're really taking quite a comprehensive approach. And that's really the sophisticated technical part of it, and also the simplicity element of it as a tool to use to accumulate assets.
That is a feature that I like a lot, in the sense that, and personally, this appeals to me, is I like the idea of essentially throwing myself in with just the broad capital markets around the world, that if they don't do well the next 30 to, I can accept that. And we're probably going to have other issues to deal with anyway. So I think that kind of diversification is very valuable.
Right.
With regards to the construction of the more short-term target date funds, there's some tips in those right now. Do you know the cutoff point at which the target date funds do not include tips? And would you view this as more of a temporary type of thing, or tips are typically always in the short-term, the shorter-term target date funds?
Yeah, I mean, tips, inflation, that's certainly the topic du jour of maybe the year 2021. But within target dates, it's been very evergreen. And the reason why tips are very important, particularly for retirees, more importantly, the accumulators, is because, again, that goal changed, right? We're not trying to raise as much assets. We're trying to preserve purchasing power. And that's what tips are. They're bonds that are adjusted for inflation. So as we get closer to retiring, we start introducing an allocation to tips. So you don't get an allocation to tips until you're about 5 years out, so let's say roughly 60 years old. And when you retire, that allocation to tips will be 30% of your bonds. So it's still not like a large part, but the role of that, again, isn't as tactical as we talk about tips maybe in this year, or as in protecting against the surge in inflation as it is. The goal of a decumulator is protect purchasing power, and that's always going to be there.
Okay.
So we use tips to do that.
Sure. Okay. What do you think are if you were to talk with the team that manages the target date fund or the group, some of the challenges in managing the series of target date funds?
Well, the challenges have been, I think, hurdled over a 30 or 40 year period. I mean, if you talk to some of the traders that have been with Vanguard really since the 80s are still on our equity income desk. And there was a time when over 90% of the volume was on 2 exchanges in the US, right? Versus now, there are, I believe, close to 30 exchanges that we trade on at Vanguard. There's 18 dark pools. There's, there's a lot of block trading. It's a very sophisticated market now. But Vanguard grew at the same time as that market became more sophisticated. And yes, we have $1 trillion franchise like Target Date Series. We also trade $1 trillion fund like the Total Stock Market Fund. So that expertise of not just starting now and doing that, because it has become complicated. There was a time when it was simple, and actually the trader mentioned that when they started and 90% of the volume was on 2 exchanges, that they were trading stocks traded in teens, right? So you didn't know your 16th table versus now, of course, it's all electronic. And this is just how much things have changed and how much evolved. But Vanguard has been there with that, has grown there with that. So in terms of challenges, I think we've gotten the best in terms of managing index assets, large index assets with the complexity, because we've been there the entire time.
Sure. Okay, great. So we've talked a little bit about the business that I work with, Nick, and I have a very large group of American expat clients, and we can help them set up portfolios, and we encourage simplicity. For example, a great mix, a great 2 ETF mix is the VT, the Total World Bond Fund, and the BNDW, the Total Global Bond Fund, or they could do a 3-fund mix with the VTI, the VXUS. But these expats have a unique challenge in that they have to use a brokerage account for the most part, and they have to buy ETFs. I would love to be able to offer the TDF to them or have that available at some point. Do you see that on the horizon at all, that the target date fund might be available in an ETF, even though it just seems so counter into like, why do you need to trade an ETF? But of course, that was John Bogle, one of his comments. Why do we even need to have ETFs? These are long-term investments. So yeah, do you think that this might be something that would develop in the future or not really?
Yeah, you bring up a really good point in terms of, and Mr. Bogle, like not like an ETFs around what he really worried him and about that would be the tradability of it, particularly in the 90s. But, we've had other CEOs that really brought Vanguard ETFs into kind of the marketplace. And it wasn't about, we've looked at a lot of this in terms of how long investors hold a Vanguard ETF versus a mutual fund. It's basically the same. To your point, yours is unique, but we have a lot of examples with different firms that we work with in the US where maybe they can't buy a mutual fund, but they can buy an ETF or vice versa. We want to make sure that all investors have a fair opportunity for investment success. We believe that we can do that with simple investments like target date series that are outwardly simple but inwardly sophisticated, but also other ETFs. So it isn't always just a trading thing. And yes, it's something that has certainly been talked about. Okay. I will say that launching ETFs is a difficult endeavor. There was probably more on the list, pre-COVID than there is now in terms of what we see in the near-term future. But I wouldn't say never, just given that the base is predominantly qualified, but we do know that there is a base of non-qualified assets, and the fact that there is a big, large asset base already, that it may make sense to do it. And it's certainly been something talked about, just maybe not on the immediate horizon.
And would your answer also be the same? Maybe it would, I shouldn't assume this, for any of the other balanced funds, the balanced index, the life strategy funds, if those were to be produced in an ETF, would they be around the same time as a target date fund, or might there be a different track for those?
It could. So for example, we launched a bond fund this year, a standalone ETF that was replicated off a mutual fund. It's a short-term bond fund that's been around for almost 10 years. Now that took a long time. But in terms of the mechanics of it, it's doing exactly what you had said. It's giving the same exposure to investors who can't consume mutual fund. Could we do that down the road with more funds? Absolutely. Right. In the past, Vanguard, we patented this dual share class, where the ETF was a share class of the mutual fund. And that's how we really achieved scale quickly in the ETF arena. What we've done more recently has been more single fund launches, which I think is, it's good for the investor. It just takes a little bit more time.
Sure. Okay.
So I think continue to see the ETFs being the preferable investment vehicle, because it's indifferent in terms of mutual fund, in terms of length of holding, but there is a logistics to getting it up to speed.
Okay. So Nick, this is awesome. I really appreciate that you came on with us, and hopefully this will convince more people to invest in target date funds. Thanks for your time.
I hope so. It's always a pleasure. I hope everybody has a great holiday season and a good start to the new year here as we turn the calendar.
All right. Thanks, Nick. Bye-bye.
All right. Take care now.
Thank you for listening to the PlanVision podcast. Let us know if you have any questions or comments on the topics covered.